Not gonna be like a real like funny video, like something that's gonna be more serious. Like I'm just doing accounting 101 because I mean accounting is not hard to me. It's not. It's just it's all tedious to me. Like so I want a better job and I called around today. And now I just found this place in Valdosta for $756. Why would I want to live in Valdosta? It's not that far from like Florida. So anyways, I'm just on accounting 101. Double entry, a fundamental. I'm gonna do this accounting 101 and stuff because I want to learn how to be a better accountant so I get a better job. Honestly. Double entry is a fundamental concept underlying present day bookkeeping and accounting. States that every financial transaction has equal and opposite effects on at least two different accounts. And the first of all, the thing with accounting is accounting calculation. It's been a couple years since I took this. It'd be devil me at the time. I was going through something at the time too, so I don't want to discuss it really. It was 2 years ago. It actually propelled me forward into this day. Actually, looking back, I missed 2 years ago. But assets always equals liabilities plus equity. With a double entry system, credits are offset by debits in a general ledger or T account. And the thing with accounting to me is always, it's not what I really want to do for the rest of my life, but hey, it's at least if you get a better job to where you can like learn, where you get like paid off, or not have to work until like late at night. Honestly, and that's being the thing about it is, in the double entry system, transactions are recorded in terms of debits and credits. Such a debit in one account offers all sides of credit in another. The sum of all credit debits must equal the sum of all credits. The double entry system of bookkeeping standardizes the accounting process and improves the accuracy of prepared financial statements, allowing for improved detection of errors. Which has actually become a big thing recently because they found a lot of people have fudged their accounting statements. A business transaction is an economic event that is recorded for accounting bookkeeping purposes. Under the systematic process of accounting, these interactions are generally classified in accounts. There are 7 different types of accounts that all business transactions can be classified. Assets, liabilities, equities, revenue, expenses, gains, losses. Bookkeeping and accounting track changes in each account as a company continues operations. Debits and credits are essential to the double entry system. In accounting, a debit refers to an entry on the left side on the account ledger, and credit refers to an entry on the right side of the account ledger. To be in balance, the total of debits and credits for a transaction must be equal. Debits do not always increase to increases, and credits do not always equate to decreases. So, a debit may increase one account while decreasing another. For example, a debit increases asset accounts but decreases liability and equity accounts, which supports the general accounting calculation of assets equals liabilities plus equity. On the income statement, debits increase the balances and expense and loss accounts, while credits decrease their balances. Debits decrease revenue and gains account balances, while credits increase their balances. So this is a lot I'm trying to learn everything about accounting. Honestly. So I'm just going to go here and do the accounting basics and stuff. I'm trying to learn as much as I can because, again, I want a better job when I have to do a crap job. In which I'm not going to be lying a job that I've done like 6 of them. So I've done the word most people wouldn't have done. So I've learned. Okay. So, let's see here. Accounting. Debits and credits. We've done this before. So like I said, a debit is an accounting entry that either increases an asset or expense account or decreases a liability equity account. It's positioned to the left, and a credit is positioned to the right, which decreases an asset. Liability accounts. Revenue accounts. A debit decreases the balance, and a credit increases the balance. Expense account. A debit increases the balance, and a credit decreases the balance. Gain accounts. A debit decreases the balance, and a credit increases the balance. Loss accounts. A debit increases the balance, and a debit decreases the balance. Again, it's not really hard. It's just like, let's go to appreciation. Assets, accounting assets and liabilities. Accounting assets and liabilities. Wait a minute. I did not. So 11 Valdosta, but Valdosta is like less than an hour from Jacksonville. What is an asset? What's a liability? Not want to be big sexy and have to do what he has to do. Accounting class at UNC. Liability definition. A liability is something a person or company owes, usually a sum of money. Liability is settled over time to transfer economic benefits, including money. Goods and services recorded on the right side of the balance sheet. Liabilities include loans, accounts payable, mortgages, deferred revenues, bonds, warranties, and accrued expenses. In general, liability is obligation between one party and they're not yet completed or paid for. In the world of accounting, a financial liability is also an obligation more defined by previous business transaction, events, sales, exchange of assets or services, anything that would provide economic benefit at a later date. Current liabilities usually considered short-term, expected to include 12 months or less, and non-current liabilities are long-term. Liabilities are most referred to the legal liability of business or individual. For example, many businesses take out liability insurance in case a customer or employee sues them for negligence. A liability, generally speaking, is something that's owed to somebody else. A liability can also mean a legal, regulatory risk or obligation. In corporate accounting, companies book liabilities in opposition to assets. Current liabilities are companies' short-term financial obligations that are due within 1 year within normal operating cycles, such as accounts payable and taxes owed. Long-term liabilities are obligations listed on the balance sheet as due for more than a year, such as bond interest payments. So things such as the owed include tangible items such as buildings, machinery, and equipment, as well as intangible items such as accounts receivable, interest paid, patents, intellectual property. So practical example understanding a term's liabilities. Let's look at historical. Example using AT&T's 2012 balance sheet. So the liability, they have like total stockholder, total liabilities, they got like $179 million, $953,000. Liability charges, they have like $28,491,000, $333,000 like minority interest. So current short-term liabilities are segregated from long-term non-current liabilities on the balance sheet. It clearly defines as bank debt maturing in less than 1 year. For companies this size, all these uses operating capital for day-to-day operations, later including larger items, which is better suited using long-term debt. Wages payable, the total amount of accrued income employees have earned but not yet received. As most employees pay their employees every 2 weeks. Liability changes often. So that's a little bit of accounting 101.